What is mental accounting? Mental accounting is when a person puts different numbers on the same amount of money based on their own preferences, which often leads to bad decisions. In the area of behavioral economics, the idea of mental accounting is used. It was made by economist Richard H. Thaler, says that people group money differently and are therefore more likely to make irrational decisions about spending and investing. Understanding mental accounting. Richard Thaler, who teaches economics at the University of Chicago Booth School of Business and wrote the 1999 paper Mental Accounting Matters, defined mental accounting as the set of mental operations that individuals and households use to organize, evaluate, and keep track of financial activities. The theory is based on the idea that money can be used in different ways. When you say that money is fungible, you mean that all money is the same, no matter where it came from or what it was made for. To prevent the mental accounting bias, people should think of money as completely interchangeable when putting it into different accounts, like a budget account, a spending account for fun, or a wealth account for savings and investments. They should also treat a dollar the same way whether they make it or someone gives it to them. Thaler noticed that people often break the fungibility principle, especially when they get something for free. Get your tax money back. Getting a check from the IRS is usually seen as found money or extra money that the person can spend on whatever they want. But the money belonged to the person in the first place, as the word refund suggests. It is mostly a return of money, in this case, an overpayment of tax, not a gift. So it shouldn't be seen as a gift, but more like daily income. Example of mental accounting. The mental accounting way of thinking seems reasonable, but it's not at all. Some people, for example, save money in a money jar or similar way for a trip or a new house, but they also have a lot of credit card debt. They are likely to treat the money in this special fund differently than the money they are using to pay down debt, even though taking money away from paying down debt increases interest payments and lowers their total net worth. Broken down even more, it doesn't make sense and is actually bad to keep a savings jar that gets little or no interest while also having credit card debt that grows by double-digit numbers every year. Most of the time, the interest on this loan will wipe out any interest you could earn in a savings account. In this situation, the best thing to do would be to use the money saved in the special account to pay off the expensive debt before it gets worse. Even though the answer to this problem seems simple, many people don't act this way. The reason has to do with how much people value certain things on a personal level. Many people feel that money saved for a new house or a child's college fund is too important to give up, even if it would be the best and most reasonable thing to do. So, it is still normal for people to keep money in an account with low or no interest and also have debt. Mental accounting in investing. When buying, people also tend to have mental accounting bias. For example, many investors split their money into safe portfolios and risky portfolios so that the bad returns from risky investments don't affect the whole portfolio. In this case, the investor's net wealth is the same whether he or she has several smaller portfolios or one big portfolio. The only difference between these two cases is how long and how hard the investor has to work to separate the portfolios. Investors often make bad choices when they do mental accounting. Thaler gives this example, which is based on Daniel Kahneman and Amos Tversky's original theory on loss aversion. An owner owns two stocks. One has a paper gain and the other has a paper loss. The trader needs money and must sell one of the stocks. The way people think about money makes them more likely to sell the winner, even though selling the loser is usually the smarter choice because of the tax benefits and the fact that the lost stock is a worse investment. The investor can't handle the pain of realizing a loss, so he or she sells the winner to escape that pain. This is called the loss aversion effect, and it can cause buyers to make bad choices. Why do we do mental accounting? People tend to treat money differently based on where it came from and what it will be used for. When you think about it more, that way of thinking makes less and less sense, and in the end, it hurts our budgets. Is mental accounting a behavioral bias? Yes, behavioral biases are illogical thoughts or actions that affect our decisions without our knowing it, and mental accounting can make us look at and manage our money in ways that don't make sense. How can mental accounting be prevented? The key to dealing with mental accounting and not giving into it is to treat money as interchangeable and not put names on it. Don't think that some money is less important because it came from somewhere you didn't expect it to. Also, don't keep putting money in a savings account that pays little or no interest when you have bills to pay back that cost a lot more. In conclusion, many of us, even buyers with a lot of experience, fall into the trap of doing mental accounting. Most people give money a relative value based on where it came from and what it's meant to be used for. Even though this method may seem harmless and reasonable, it can backfire and hurt us financially.